Hello folks, this is Tony Drake from Drake & Associates with an educational economic update for March 2018. In this month's video, I'll discuss some of the major headlines that influenced markets in February. I'll also provide insight into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. Domestic markets started 2018 with their best monthly performance since at least 2016, only to stumble in February. Both the S&P and the Dow had their first monthly losses in 10 months, breaking their longest winning streak since 1959. Overall, the S&P lost 3.9%, the Dow 4.3%, and the Nasdaq gave up 1.9%. These losses came as volatility picked up throughout the month. In early February, we experienced back-to-back sell-offs followed by large jumps. During 1 week, the Dow lost 1,000 points and gained back 300 twice. But this volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the labor report indicated that wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for both housing, new and existing, dropped in January. Housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of fourth quarter GDP at 2.5%. The growth matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. By the end of February, comments from new Federal Reserve Chair Jerome Powell led some investors to believe that interest rates may in fact rise faster than anticipated. In testimony to the House Financial Services Committee, Powell spoke of growing global strength and stimulative fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018. On February 27th, stocks dropped significantly in response to his testimony. The volatility continued the next day as stocks whipped back and forth before ultimately ending down. If February's volatility feels unnerving, that may be due to the market's unusual calm in 2017. Since 1980, the average annual S&P 500 correction has been about 14%. Last year, though, they only fluctuated about 3%. When considering last month's fluctuations, remember that positive economic perspectives were behind a lot of the movement. Despite the volatility, consumer confidence easily beat expectations and showed people that they feel particularly good about the labor market. Jobless claims supported this perspective as new unemployment filings remain near historical lows. Moving into March, we'll pay close attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates again and provide greater insight into their expectations for the year ahead. As developments arise, we'll keep you informed. Now that's it for this month's educational economic update. Please visit us at wealthwisconsin.com to learn about our upcoming workshops and be sure to listen to our Retirement Ready radio show on WTMJ Saturdays at 1 o'clock. Once again, this is Tony Drake from Drake & Associates signing off for the month of March 2018. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call. We'll be happy to talk to you. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or the solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Thanks.